Company is Cancambria Energy. They're a Canadian-based exploration and production company focused on the development of their Hungarian assets. They're working to develop this resource, obviously to have a big impact on Europe and on Hungary. Here to tell their story is their President and CEO, Dr. Paul Clark. Please welcome him.
Yeah, well, good afternoon, everybody. Pleasure to be here. This is Cancambria's second year presenting at Enercom, and we're really thrilled to be able to share our vision for natural gas development in Europe. So, as you're probably well aware, Europe is in the middle of an energy crisis, and we want to be part of that solution. Natural gas over in Europe is trading at around a 500% premium to North American prices, and we'll speak a little bit about that as we go through the presentation. We are a pre-revenue company, as you will see. We'll speak at length about resource numbers and draw your attention to our forward-looking statement. All of the reports and materials that I share are available online, SADAR Plus, so we're very diligent about getting that information out if you want to do additional homework. We entered Hungary with a 5-year plan. We're on year 4, so we're very close to getting the company into revenue. Our vision is to be drilling and producing in 2027. I joined the company specifically to work this Hungarian asset. We built the project from ground zero. We had essentially no footprint when we entered 2022, 2023. We put together a very significant land position. We have over 1,000 square kilometers, roughly 250,000 acres. We've spent a significant amount of money in the region of $4 to $5 million on proprietary 3D seismic. All of that is aimed at better delineating and characterizing the resource. There were a number of wells within the area that we focused, but there was no high-quality modern seismic. And so the seismic was really critical in putting together these resource numbers. We have a couple of different plays that I'll speak about. A deep, tight gas play, unconventional play. That is what you see described in terms of contingent resources in excess of 570 BCF with additional liquids. And that has an NPV 10 valuation upwards of $2 billion US. That corresponds to around 100 vertical drilling locations, and I'll show you some maps that substantiate those types of numbers. We feel that for a number of years Europe was not a place to operate. Many jurisdictions weren't friendly to oil and gas companies. Hungary is one of those areas that is very receptive. They have huge need for natural gas. Slide number 4 here illustrates essentially the same breakdown of our portfolio. The central image is our land map. We have around 250,000 acres at 100% ownership. If you're from Colorado, that's about the same area as Clear Creek County, so a very large area. The position we picked up, shown in orange, the small polygon off to the south and to the east, that's our deep tight gas project, around 3,000 to 3,500 meters drill depth. That is where almost all of our contingent resource resides. We are doing vertical drilling, multi-stage stimulation in that region. That essentially is drill ready. We have 2 permits approved, an operating plan approved, and we're in the process of bringing in a joint venture partner to underwrite the initial investment into the first series of wells, the initial 2 to 3 wells in that region. The larger area off to the west there, in particular the northern part of the basin, we picked that up in 2025. It was a competitive tender situation, the 8th licensing round. That is an area that also has deep tight gas potential, but noteworthy is a shallow oil play that MOL and others are pushing right the way through Croatia and also Hungary. It's a very simple model whereby you come into regions that are proven to be productive, acquire new 3D in areas that were originally bypassed, and then go drill relatively shallow oil wells. And that's a play, it's a little less mature for us. That's a play that requires 3D. We're looking to accelerate. We have a 3D commitment for 2027. We're looking to accelerate that 3D into the second half of 2026. We'd like to get that 3D, given where oil prices are at. We'd like to get that 3D this year rather than next year. Our vision is to run these two projects in parallel. The shallow play is something that we can accommodate 100% at Cancambria. The well costs $2.5 million, so quite a lot more attainable for a company of our size. Investment highlights shown on the left and the capital structure on the right-hand side. Once we get the commercialization of this deep tight gas play we have, it's somewhere between 10 and 15 years of drilling inventory with a single rig program. Likely we would accelerate and bring in additional rigs, but even the one rig program would deliver upwards of 20% production growth annually. Natural gas, as I'm sure you're aware, is trading at a very big premium, $18 to $20 per MMBTU. Hungary is very pro oil and gas, very good terms, both fiscal terms, royalty, and I'll talk about that. And the asset is world class. I've spent all my career working with large independents, and this asset passes the muster with respect to all the key parameters that we look for. The team that I've assembled similarly has a very good track record of organic growth, value creation. You know, we are not pure explorationists. We're not in the desert. We're not in the deep water, but we are in proven basins returning shareholder value. Market cap in the region of 40 million Canadian. Clean share structure, no debt. We believe, currently we're trading in that 30 cents range. What that looks like relative to our peers, we consider we're substantially undervalued. The pre-revenue peers 1 through 3 are shown. The companies are highlighted along the bottom. That gives you a sense of where we should be trading. We're about 1% of our EV relative to the value of our 2C, contingent resource there. The peer group is 2 to 4%. The remaining peers 4 through 10 are early stage companies. These are all Canadian listed companies, and gives you a sense of where within 12 to 18 months the company might be in terms of valuation once we get this first gas and then the oil project into revenue. I'll spend just a couple of moments talking about the team that we've assembled. My background, I spent 15 years with Pioneer Natural Resources in Dallas, working their Eagle Ford and Permian assets. Cancambria today looks a lot like the Eagle Ford asset team did back in 2010. Small, agile, lean and mean, geologist, engineer, drilling engineer, so on and so forth. I will mention we added Jay Stratton to our board of directors. Jay comes to us from Ultra Petroleum. He and I worked there. We overlapped for 3 years working Pinedale, which, if you know Pinedale, is actually quite a good analog for what we're trying to accomplish over in Hungary. He was also at Jagged Peak, COO. His role for the company, once we start drilling and operations, is to bring down costs. Europe, as you know, very expensive to operate, and that's certainly one part of the equation that we look to bring down over time. The initial wells we drill, really, we don't have too much flexibility in terms of cost. Pete Van Asch is our COO. He's located in Budapest. As you would imagine, very important to have networks into both the government and the regulatory bodies over in Budapest. It's a very small community over there, and we are very proactive, engaging in that regard. Just to comment on natural gas, we certainly entered Hungary on the back of Russia-Ukraine. Prices have not really come down much. They're in that averaging around $12 to $14. That conflict, as we know, continues. And then earlier this year, the natural gas prices, primarily as a function of LNG supply constraints, moved higher again, and today they're up at $20, $21 per MMBTU. We certainly don't need prices in that range. We would be happy to have pricing in the 14 to 16 range. It raises issues about profit taxes, etc., so on and so forth in Europe. Very topical with companies obviously much larger than ours, Shell, BP, and others. So, our break even is down at $4. We do have a liquids component, which is a buffer on the natural gas sensitivity to price. The outlook for natural gas is still strong. The oversupply on LNG seems to be pushed out somewhat, given the Iranian issues. European gas storage is at decades-long lows. And importantly, for Hungary, the European Union policy, the Russian gas needs to come out of the system by the end of 2027. I'll break to talk here about the timeline that we've put forward over really the last 12 months was impacted by some of the macro, some of the geopolitics. We put together a joint venture farm out process with Raiffeisen. We did that out of Austria. They have a good network over in Europe. We announced that back in October of last year, and our plan there was about a 9-month process. That process is coming to a conclusion. We're in commercial negotiations with parties over in Europe, taking quite a lot longer than we anticipated, primarily due to the Hungarian election there. Viktor Orban is of course out. The new party, Peter Major's party, is in. We are essentially neutral on that change of government. Maybe they're a little more leaning towards European Union policy. They're certainly looking to bring in a lot of investment, a lot of EU money that was earmarked for Hungary. That will likely go towards solar and other renewable energy sources, but that is to the betterment of the diversification of the energy landscape in Hungary and Europe. Hungary still imports most of its natural gas through pipelines in Turkey from Russia, and to be compliant with European Union policy, they need to move away from that over the next 12 to 18 months. So a little more on the asset itself. Unconventionals in Hungary receive extremely good fiscal terms. Taxes are low. The government the royalty is only 2%. So we have a very attractive gas basis. We have an extremely attractive royalty where we keep 98% of the product that we produce. The infrastructure in the region is good. The services are good. We have takeaway capacity for when we drill those initial wells into sales. And one of the first wells in the field that was drilled back in 2008 had about a 6-month production test. Was drilled outside the main fairway, the main productive fairway. A lot of information about the wells is shown on this slide. It's not particularly relevant for our discussions here today, but just rest assured that there is a lot of information, logs, core, production, a lot of well-related data within the field that helps to guide these resource numbers. That really the missing part when we came in 2022, 2023 was seismic. There was no way to adequately describe the distribution of the resource. So we underwrote a proprietary 3D survey. The image shown here is the old 3D for the region. This area had Hungary's first 3D seismic survey, a dynamite survey that was acquired in the late 80s. That's the image on the right. The image in the center, that's our new proprietary 3D. And you can, if I just show you, the basement is shown here, and the reservoir interval is very well delineated. So we can identify both, shown in the structure map here, the edges of the accumulation and also the internal architecture of the field. We can also start to understand rock quality parameters based upon seismic amplitude and AVO type attributes. So we have a very good understanding of the field. You know, many resource players will have a large recoverable number as a function of a very large area. Here, we're talking around about a 4,000 acre field. So we're not talking about a very, very large field. We're talking about almost a surgical approach to the development. I should say the area here contains around 50 or so vertical wells on 40 acre spacing. So a little bit on the contingent resource numbers. We started out with around 2.5 TCF. That was pre-seismic. You know, my board of directors at the time, my investors were asking me on the back of the 3D, how much larger would the accumulation get? You know, we tried to educate them that what will happen is the area will be focused to a smaller area, but will improve significantly in terms of confidence. And that's what we observe. We have now a 1.2 TCF in place, technically recoverable, risk recoverable shown at 572. and then you got that NPV of the 112 drilling locations. Those wells are all equally distributed. The only difference in NPV from phase 1 and phase 2 is the time sequence. This is one rig, so the first 10 years represent phase 1. The next phase 2 is the next 5 years of drilling. So the discount factor of time is really the only change. We typically talk primarily about the first 50 drilling locations, which comes to kind of phase 1. You know, it's early to show cash flow waterfalls, but with the input parameters that we do have, you know, this is a cash generating machine once we get to scale, once we commercialize the field. We're talking about wells that will produce around 5 to 6 BCF. Revenue, very significant. You can see here the very small royalty take from the government, CapEx, OpEx, and significant free cash flow, and the growth shown on the right-hand side here over at least the first 10 years. As we add wells, typical of tight gas, as we add wells, we grow production. On an individual well basis, these wells are highly economic. We use a base price of $12. They're even more economic if you factor in, you know, 14, 15, 16 bucks. But these are very economic wells. Classic tight gas shape, high initial rates, steep initial declines, hyperbolic with a 1.1. We also have flow simulation that we've done in-house, which evaluates the multiple different intervals. We plug into that model porosity, permeability from already collected data within the field. So these wells, they net back well in excess of well cost over the initial first year of the well. So even on a single well basis, you know, these wells are very economic. The one caveat here is we're talking about $18 million to drill these wells in Hungary, so they are very expensive. That was really the rationale to bring in a partner, was to underwrite the initial costs to get this project into commercial production. So if you ask me what's the activity level in Hungary, who are the main players, the map here shows that the country, most of the activity is dominated by MOL. You know, they are the large billion-euro integrated oil and gas company. They have been very successful in shallow oil exploration. Being a large company, they don't announce all of their discoveries. Every once in a while, they'll make an announcement about a well that exceeds 1,000 barrels a day. So to the north of us and to the west of us, they made some fairly significant oil discoveries in excess of 1,000 barrels a day. This is typically within the first 1,500 meters of the column, so this is relatively shallow. This is seismic-driven exploration, and they are immediately to the north of our position. MOL acquired a 3D seismic immediately north of our position back in January as they look to develop the shallow play. There is one deep unconventional play in country, Aspect, and MVM have a project which is in revenue. They've drilled around 7 wells. To the best of our knowledge, they're cash flow in a couple of $100,000 a day out of that asset, but details, given that they're private, details are a little bit tricky to come by. But that is a little bit deeper than ours, a little more hostile than our deep play, and has some technical challenges that we don't have, given that we're a little bit shallower drill depths and temperatures and pressures. So I'll just spend a couple of slides talking about the shallow oil play. Really excited about this block of land. As I said, we put in a competitive bid for the land. Other companies really wanted to pick up this block, and it's really the northern area. The kitchen I'm showing you here, this is the area that's oil prone. A number of fields to the south here produced up to around 160 million barrels. Multiple different productive intervals from fractured basement all the way up to 20% porosity sands in the shallow Pannonian, structural traps, DHIs on the seismic. The creaming curve on the upper right-hand side shows you the Soviet era development and investment. Gravity magnetics, early 2D, discovered some of these larger fields, and then essentially no investment from the early 90s onwards in this region. So our philosophy here is we come in, we acquire the 3D and anticipate running into a good number of prospects. We've got 10 prospects identified from 2D seismic, which have a fairly good size to them. They're smaller than our deep Thai gas project, you're talking between 300 to 400 acres in aerial extent that could support between 2 and 10 wells. There is a lot of data available if you're prepared to put the work in to mine through that. A lot of it's in Hungarian, a lot of it is physical hard copies, but we have a team diligently working through the data sets over in Hungary, digitizing rasters and pulling all of that understanding into our subsurface database. This area, as I said, does need a 3D seismic survey to better delineate those DHIs. The production from the fields is shown here, and we have a mean field size of around 15 million. So we think that we can identify something between 2 million and 15 million on any given prospect that we're looking at. Our vision here is to, by the time our 3D seismic is in, we will have all the subsurface data in order to put together a prospective resource evaluation, probably by Q1 of next year. And so I'll wrap things up just talking a little bit about gas price. Of course, we moved our base price assumption from $10 gas up to $12 gas, and added some value to the corporation. It also gets eyes on the natural gas story over in Europe. We don't feel comfortable going any higher than $12, but certainly there's value to be had if we're in revenue, and these prices still stay high. Liquids, of course, is the other part of the story, and we see strong oil prices indexed to Brent over in Europe, whether it be condensate for our deep play or the pure oil play that we're looking to develop. So with all that being said, Europe for a long time was a place that you probably didn't want to go operate. A number of jurisdictions weren't really welcoming of oil and gas companies. Europe now is a strategic advantage for Cancambria. We have an established footprint, an established land position, an enviable land position that is pretty difficult to put together. We have very strong economics for both projects, albeit they're at the pre-revenue level. And now we have a balanced portfolio, not just the deep, tight gas, which is more capital intensive, but also maybe the flexibility of a smaller oil-weighted portfolio that we can nip in, and we can drill these relatively inexpensive wells and grow revenue. Near-term catalyst for the company, we hope to get this joint venture concluded over the next several weeks probably into Q4. That is by far the biggest catalyst for the company. Once these initial wells are funded, we're looking to farm out somewhere in the region of 30 to 50% for a drill carry in the early phase of the project. I think that's a big mover for us. We are also in parallel looking to fund a 3D seismic shoot before the end of the year. That would then be drill ready by mid-2027. So we're hoping here that we would be drilling almost in parallel the deep gas and the shallow oil by mid next year. So we're very excited what the next 12 to 18 months holds for the company, and we're happy to take questions. Thanks for your time.